From the moment a tanker leaves the Persian Gulf, to the instant a factory in Asia pays a supplier in Europe, to the reserves quietly sitting in the central bank balance sheets. That currency is the US dollar. It's so embedded in our daily life that most people never stop to question it. But quietly, without headlines, without announcements, countries around the world are preparing for a future where the dollar is no longer dominant. Not collapsing, not disappearing, just slowly losing its grip. This process has a name: de dollarization, and it's already happening. At first glance, nothing appears to be wrong. The dollar still makes up nearly 60% of global foreign exchange reserves. Most global trade is still priced in dollars. And when uncertainty rises, wars, financial crises, recessions, capital still flows towards the dollar, not away from it. Even countries that openly criticize US policy continue to hold vast amounts of dollar assets. So if the dollar looks this strong, why are so many nations quietly preparing for something else? Because true dominance doesn't disappear overnight. It fades in the background. And by the time the change becomes obvious, the decisions that caused it were made years earlier. To understand why confidence is shifting today, we have to look at the moment when trust began to change. Not gradually, but suddenly. The real shift didn't begin with inflation, or interest rates, or even America's rising debt. It began with sanctions. For decades, access to the dollar-based financial system was treated as neutral, almost automatic. But over the past 10 years, that access has increasingly become conditional. The clearest example came after Russia's invasion of Ukraine. In a matter of days, hundreds of billions of dollars in reserves were frozen. Major Russian banks were removed from SWIFT, and access to the dollar-based system vanished almost overnight. From a geopolitical standpoint, the sanctions worked, but financially, they sent a message far beyond Russia, not just to adversaries, but to everyone. If your reserves are held in dollars, if your trade relies on dollar clearing, then your economic security depends on US political alignment. For many governments, that realization was sobering. This wasn't about sympathy for Russia, it was about precedent. And once a precedent exists, it cannot be ignored. To understand why this mattered so deeply, we need to rewind. After the World War II, the United States stood alone. Its economy was intact, its industrial capacity unmatched, its financial institutions stable and trusted. Under the Bretton Woods system, the dollar became the backbone of global finance. First backed by gold, later backed by confidence in the US institutions. Over decades, trade was priced in dollars, debt was issued in dollars, commodities were settled in dollars, and central banks accumulated dollar reserves. A powerful feedback loop formed. The more the dollar was used, the more useful it became. But beneath all of this sat an unspoken assumption that the system was predictable, rule-based, and politically neutral. Once that assumption weakened, the foundation began to shift. And when trust erodes, countries don't panic, they plan. De-dollarization isn't dramatic. There's no announcement, no replacement ceremony, no single alternative waiting in the wings. Instead, it looks like quiet adjustments, small moves spread over years. Countries begin settling trade in local currencies, central banks slowly rebalance reserves, and payment systems are redesigned to reduce exposure to US controlled rails. China and Russia settle much of their trade in yuan and rubles. Brazil and China trade directly without converting to dollars, and India experiments with rupee-based settlement mechanisms. Even oil, long the pillar of dollar demand, is no longer exclusively priced in dollars. These are not symbolic gestures, they are insurance policies. And no one understands the need for insurance better than emerging markets. For emerging economies, the dollar is a double-edged sword. When the dollar strengthens, dollar-dominated debt becomes more expensive. Capital flows towards US assets, and local currencies weaken, which accelerates inflation. This cycle has repeated for decades. Latin America in the 1980s, Asia in the 1990s, repeated debt crises ever since. Many of these countries didn't choose the dollar, they adapted to it. Now they're trying carefully to loosen its grip, not out of ideology, but out of survival. Which raises the inevitable question: If so many countries want alternatives, why hasn't one replaced the dollar already? Well, because replacing the dollar is extraordinarily difficult. The dollar remains the most liquid currency in the world. US Treasury markets are unmatched in size and depth. No other system offers the same combination of scale, trust, and accessibility. The yuan isn't fully convertible, the euro lacks unified fiscal authority, gold lacks flexibility, and crypto lacks stability and scale. But here's the crucial point: the dollar doesn't need to be replaced to lose influence, it only needs competition. And for the first time in generations, alternatives are becoming good enough. And when the structure of money changes, so does power. A less dollar centric world doesn't collapse, it fragments. Sanctions lose reach, borrowing costs rise at the margins, trade becomes more regional, and financial power becomes more evenly distributed. Instead of one financial gravity well, multiple centers begin to form. This doesn't mean chaos, but it does mean the United States has less leverage than it once did. And that's a historic shift. De-dollarization isn't a revolution, it's a repositioning, quiet, methodical, already underway. The dollar will remain powerful for years, possibly decades, but the world is no longer building its future around it alone. And once global finance learns how to function with multiple anchors, there is no going back.